Well, Peter Schiff joins us next. He's the CEO of Euro-Pacific Bank to talk more about positioning, about markets, how to think about 2014, heading into the new year, if I can spit my words out, Peter. How are you, and how are you viewing life at the moment and trading and markets?
Well, I'm fine, thanks for asking. And, I think there's a lot of disconnect right now in the markets. I think people have much too much confidence in the legitimacy of the U.S. recovery. They're expressing that by bidding the dollar higher. But I think people who think we have a real recovery are going to be very disappointed. And I think people who are buying the dollar are going to suffer losses as a result.
Why do you think that it's not a real recovery?
Well, because I think it's all a function of the cheap money, the 0% interest rates, the quantitative easing that the Fed has just tapered down. And I think as the Fed is no longer propping up the economy to that extent, and now it's threatening to actually raise interest rates, I don't think the U.S. economy, with the level of debt that we have, can actually withstand the higher interest rates that everybody believes the Fed is going to unleash on the economy.
Peter, I can, definitely understand some of your concerns about the risk of tapering. I guess my question is, when I look around the world, I struggle to find another economy to have significantly more confidence in. So Europe has got this lack of structural reform. China, we have a question over asset values and real estate bubbles. And Latin America is so impacted by the commodity boom. Where else is going to grow?
Well, we haven't had structural reform either. We're simply borrowing more money and spending more money. We just posted last week the largest trade deficit in our history in manufactured goods. So to a greater and greater extent, America is relying on the production taking place outside the United States so we can continue to live beyond our means. Meanwhile, even the GDP numbers that came out today, the big reason for the upward revision is the huge increase in health care spending. Americans don't want to spend all this money on health care, but they're being forced to. And if you look at all the other economic data points that come out, other than GDP, or maybe the headline payroll numbers, almost all the data that's been coming out for the past several weeks has been extremely weak. In particular, the new home sales that came out today, the existing home sales that came out yesterday, real estate sales are tumbling, and the Fed still hasn't raised rates. We've got mortgage interest rates at record lows. Now we've had the temporary relief of falling gasoline prices, yet consumers still can't afford to buy houses in this environment. What's going to happen if the Federal Reserve makes buying houses more expensive by raising rates?
Mortgage data has been okay, though, hasn't it? I mean, the mortgage approvals.
No. Look at the data. Look at the numbers that have been coming out. The sales are really falling. The price increases are reversing, and this with lots of support. In fact, just recently, Fannie Mae and Freddie Mac came out and said that they would now put U.S. taxpayer guarantees behind mortgages with just 3% down. The reason they're being forced to do that is because fewer and fewer Americans can actually qualify for a mortgage because incomes are not rising. Incomes are actually falling. In fact, if you look at this so-called recovery, the average American is earning less today than he was when the recovery began. The average American has a much lower net worth today. Despite the increase in the stock market, the average American has a lower net worth today than when the recovery began.
Peter, I hear what you're saying. We've got about 30 seconds left on your bird as well, just FYI. The problem is, though, that even with these arguments, markets are still going up, and you don't want to fight the Fed.
Well, Markets are notorious for getting it wrong. Look at how strong the markets were in 1999, leading up to the big decline in 2000. How strong were the markets in 2006, 2007, on the eve of the financial crisis and the Great Recession? So I think, once again, the markets are pricing in a prosperity that's more illusion than reality. And I think we're setting ourselves up for a big disappointment. I think when we get the GDP numbers for Q4 and Q1 of 2015, they should be way below expectations, and I think all the talk about tightening is going to be replaced with talk about QE4.
Peter, your bird's about to fly. Thank you very much. Happy holidays. We'll see you in 2015. Peter Schiff joining us from Euro-Pacific Bank. What would you like to see happen?